And ooh, Professor,
That's what they call me. I'm trying to get them to call me that. So good
Professor Webb.
afternoon, gentlemen. Hope you all are having a wonderful day. This is going to be the first step into understanding the information that people just rarely talk about, right? If you're not necessarily talking about this, sounding like a financial guru out here, you're rarely talking about this information, and I think it does go over our heads a few times. I know maybe it's just for me. I felt like some of this information just went over my head a lot of the time, and I just felt it was necessary to get an understanding on what's out here, right? Because we say we want to be financially fluent, it's kind of like a language, right? So you have to be fluent in other languages to understand how the language is spoken. This is no different. So once you understand how this conversations are had in Wall Street on those corporate accounts, those big name individuals, they take time to really understand the information being spoken to them, or they hire somebody to do it. Either way, someone needs to be able to translate it. So my job here is to help us understand and translate what financial freedom really looks like. Because when we say financial freedom, what does that really mean, and how do we really get there? Well, first we have to understand where we're messing up at, right? We as a people, we're not perfect, right? There are some areas where we stop learning, right? Because if you never go to college or you never go to a trade school after like your grade schools, you're not put in the setting where you have to learn something, right? Where it's encouraging learning. You're just going out to the world, letting the world be your teacher. But if you're not sitting down, researching this information, understanding this information, you rarely would know what it means, right? You can catch some understanding of from certain people you might listen to, maybe some people you follow online, but really, even majority of Americans, if I want to throw a number on it, about 78% of Americans stop learning about finances after school. You don't go to school for it, you don't learn about it, you lose what you don't know. So they end up being in a position where they live paycheck to paycheck because that's basically the default. That's default setting on how you're living your life if you don't understand how this finance, how your money works. And we as humans, we build up habits that come from our behaviors, right? We are our own habits. We're the sum total of what we do on a daily basis. And if you're constantly in the mode of spending, 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 and then at the end of the day, you feel like you have to try to survive, scraping money together, that's a behavior that we can pick up just from trying to survive in this topsy-turvy world we live in. So there's certain areas or certain gaps that we don't even realize that's playing out to where we spend to find that endorphin, to find ourselves enjoying life again. We feel like to spend money, right? That's a social construct that we've all been indoctrinated into, born into. And it's our job to recognize these habits, number one, and find ways to work towards maybe changing the habit or enhancing the habit if it's a good habit to have. Because there are good habits out there, and people tend to exemplify some of them. But our goal here is to help us uncover the habits that we may not even recognize that we deal with. So, along with that, understanding the world that we live in is a big reason why people don't get how money works. Because a lot of times when you sit down, anytime you try to scroll online, maybe go on social media to kind of get away from the day, you're constantly being sold to, right? Companies are on there advertising something, advertising some service, some product that people spend billions of dollars into, trying to convince you that you need something when you really don't even want it. So recognizing that this is the world we live in, social media isn't like it was when it first started, where it was like you were following your friends, following your family. Now you're following companies that are constantly, consistently trying to sell you something that you may not need, but they're going to spend money to make you feel like you need it. Because once they get into the culture, as they say, now you have to do it to be a part of sale culture. So I believe we all have to take a step back from the indoctrination we're being put into that we need certain goods that we don't need and understand how our finances and how our pockets really work. So first things first, understanding and recognizing where we may fall off is the first step, right? Recognize you may have a problem, but a lot of times it's a problem that can be solved with a little bit of conversation and a little bit of education. So where do we start off? We will start off needing to know the basic accounts, right? So when you think of your accounting terms, if you're trying to be an accountant, I've been an accountant for a while. It's not the funnest job I've been in, but it was a necessary job to understand these different terms at the level that makes sense, right? Because a lot of times people talk about assets, liabilities, equities, but do they really know what these terms mean? A lot of time people say they do because at a certain point we feel like we're supposed to know these words. And because we don't know them, we feel as if we're less than. So we try to pretend like we know words, and that's okay, right? I'm not trying to call anybody out here. I play pretend all the time. But I think it's important to really know what these terms mean and understand when you see them what they're referring to. So let's take the first one here. Of our five building blocks of wealth, I like to call them, we have our assets. So when it comes down to our assets, basically things that you own, right? So think of your home, think of your phone, think of, I'll see if I can continue to rhyme there, but I lost track there. But think about your car, things that have value that somebody would spend or give you money for if you were to sell it. Or it might be something that makes money for you, right? So if you think of real estate like your home, you rent your home out. Well, now you have a way to generate some income, generate some money to put into your pocket. And an asset has a certain amount of value that can be calculated to give you an idea of how much you were worth in a sense. We'll talk a little bit more about that, but just for understanding, basic understandings, assets, things that you own that have value. But when we take a look at things that you owe money on, think like credit cards, think like a mortgage, things like student loans, this is where we're going into the term liability. So when you think about a liability, this is a term that basically means you owe somebody something, right? You owe some debt, you owe your friend from that back home, you owe $25 to. These are some ideas that if you have something you owe to somebody, count that as a liability. So any debts, any obligations you might have made, that counts as your liability. So the things that you owe money on. And if you take your assets, the things you own, and then take your liabilities or subtract your liabilities, the things that you owe, you have something that we in the business like to call your net worth. So again, this is how you calculate that net worth. Have you ever heard that term before? This is how you make it sense of it, right? Take the things you own, subtract the things you owe, boom, you have your net worth. But you may see it out there as another term, right? You have what you call equity. So you might call it equity if you own a company, right? They like to call it equity or owner's equity when you take a look at assets and liabilities because, surprise, surprise, companies also have assets, they own things, and companies also have liabilities. They owe people as well, just like we owe people. The government owes people just like that. Every entity that you can think of tends to have some type of asset or liability attached to it. So these are the big three that you want to remember, but there are two other terms we want to talk through, known as your revenue and your expenses. So think money coming in, profit that you made, money you make from your job, all of that will count as revenue, money coming in. But then on the other end, you have your expenses. That's your money going out. So if you think of your bills you have to pay. So if you have to pay your light bill, your water bill, gas, you have to pay your taxes. All of those will be known as your expenses. So again, money coming in, revenue, money going out. Those are your expenses. Do want to pause here. Does anyone in the audience have any questions on anything that we've covered thus far? All righty. Well, do you have a question?
I do not.
Okay, okay. Well, if you don't have any questions right now, maybe I'm doing that bang up of a job, or maybe I haven't tapped that vein that you need to learn a little bit more about. So let's see if we can get more out of this. So, what were those terms we just went through? Where will you see them, right? If you think about how they're placed or where you'll find them, we have terms again, understanding the language, understanding what these words mean. Let's talk about what they call a balance sheet. So, cool thing that we just went through, you understand what a balance sheet is because your balance sheet is nothing but your assets and your liabilities. And remember, when you subtract what you owe from what you own, you have that equity that we talked through, that net worth. So this is a simple formula that can help you really understand your personal finances. But if you're into investing, or maybe you're a trader, whatever you want to call it, this is something that's very important to understand when you think of that fundamental analysis, understanding the fundamentals behind a company. Remember, companies have assets, they have liabilities, and they also have that equity. So to think through what a company owns and what a company may owe money on, if you see a little bit more in terms of owing than owning, excuse me, maybe that company is what they call underwater by a second, but they have more debt than they have equity in a sense. But when it comes to your balance sheet, use this as a way to break down where you are. So let's do this exercise. So if you have a piece of paper or something to write on, hoping you did, hope you came prepared to take notes. This is something that I want you to take away with is understanding what your balance sheet is. So when you think about those assets, when you sit down, well, let me take a step back because you have to pretty much know what these assets we're going to be discussing are when it comes to your personal assets. So what assets you need to know about? Well, you have what you call your liquid assets. So we're going to break it down here. So when you think of liquid assets, think about the money in your pocket, right? Literally, if you have any money in your pocket, that will count as a liquid asset because it's cash, right? Cash, coins. Then you want to take a step further, just take a look at your bank accounts. Understand where your dollars are when it comes to your checking, your savings accounts, and really just think about what else you may have at a bank, like a CD, which stands for what they call a certificate of deposit. This is basically a debt instrument that's used by a bank that allows them to borrow money from you, just like how you borrow money from a bank. They'll basically borrow money from you and pay you a little bit of interest for that, right? Just like you have to pay interest on your debt, you can make a little bit of money on that debt. So your CDs can act as a way to generate a little bit of capital, a little bit more interest you might receive than just sticking into a savings account that might not be paying as much as you need. And then along with that, you have those money market accounts that have a little bit of interest that acts kind of like a checking account in a sense, right? You can go in, pull money from it, but you may have a little bit of extra interest that comes from your money market accounts. What other assets are out there? Oops, got excited. What other assets you might have out there we call our property assets. So think about your real estate and not just real estate because we tend to excuse me, we tend to tie the term property just to real estate. It can mean a lot of different things. So think like your cars you drive, your company's car, your vans on the road. These 18 wheelers all are considered property assets because they're vehicles, collectibles. So any art you might own, maybe you collect cars as a collector's item. Anything like that, if you have a way to maybe you have a baseball card that you've been waiting on, Yu-Gi-Oh cards, your Pokemon cards, whatever the case may be. These are known as some collectibles that act as your property and any personal possessions. So think jewelry, think things that mean something to you. Like it may not have to have a price tag to it, but if it's something personal to yourself, it can be considered an asset for you. So any personal possessions that you could possibly get insurance for, think of that as your property asset. And along with that, something that I love a little bit more than enough, your investments. So as an investment advisor, I'm crazy about this type of asset class because this is where people have their fun, right? When you think about the stock market, thinking about investing, putting your money into the market, these are some of those assets that you can invest in. So think of stocks. Stocks are a way to show ownership of a corporation, right? It's like a certificate saying, hey, I own 1% of Walmart or Amazon or Tesla. You act like an owner and you can benefit from it as an owner can, including making money off of the profit that the company makes. You get a piece of that in the form of what they call dividends. Along with that, you have what they call capital appreciation. So your money can grow if you own stocks. And stocks are important, right? Because they do carry some risk. And think of these investment assets as something that does inherently carry some type of risk. There's some risk involved. But for the risk of your money being lost, you losing whatever you put in, you have a way to generate some income because the assets that you own here, they're traded on an exchange. And these exchanges will give you money for the asset that you're trading. So you have a way to take your money out just as much as you put in. Hopefully, you have that capital growth or your dollars will grow with your stocks. Bonds. Bonds are a cool type of debt security, meaning that if you, let's say, take an example, you go to the bank, you say you want to take out a mortgage, right? Well, you owe money to the bank now. That's a liability that's been created, right? Now you owe that money to the bank, to the mortgage company, that you'll pay them back the money that you're borrowing them from them to buy your home. Well, a bond allows you to flip that around on its head because now, if you own bonds, you're basically letting companies, the government, different municipalities borrow money from you as an investor. And as an investor, just like you have to pay interest, you will receive interest from your bonds that you own. It's a lot more that goes into it, right? You have those fixed income traders or those debt traders that love this type of investment. But it's for those, if it wanted to be suitable, you would think of those that wanted to make a little income, right? Because the interest that you're receiving, that's the income you make from your bonds. So if you're looking for a little bit of income that does carry some type of risk, you have some bonds there. Might not be as risky as stocks, depending on who you talk to, but they still carry some inherent risk when it comes to these investment assets. But if you want to get a little bit the best of both worlds or have it to where you have diversification or multiple avenues to get different assets. Well, you have different funds you might hear about. So, mutual funds being one, index funds. Mutual funds are special because they're going to be a way to pool dollars together to go out and buy different stocks, buy different bonds. And instead of you having to go out and individually buy each one on your own, you can buy into a mutual fund. They will charge you a fee for it, but they'll have someone managing that fund, making sure that whatever objective you may have, maybe you're looking for income, making money, maybe you're looking for growth. It's the funds manager to make sure that they return an investment, return on it, an investment in the investments that you set out for them to create. So, I also want to make sure that you're investing for the future. So this is where your retirement accounts come in. IRAs, Roth IRAs, IRAs. What are IRAs? I'm sure somebody was asking. Well, it stands for your individual retirement accounts, allowing you to put money away while you continue to work to sustain yourself now. And then we have those more riskier type of assets out there known as your digital assets. So if you're into Bitcoin, Ethereum, all these fancy cryptocurrencies that are out there. Well, this gives you a way to show some store value that can grow exponentially. So cryptocurrency are fairly risky because you do run into a lot of scams out there. You run into a lot of rug pulls. So it is smart to be cautious when it comes to these cryptocurrencies like Bitcoin and Ethereum. But if you want to think of it the way I do, I see cryptocurrencies as the next evolution of what money looks like. So if you think about commodities for a second, like gold, at one point, only way you were able to buy anything is if you had some form of gold. Well, we have now moved past the gold standard. When we use gold, when we back our dollars by gold anymore, we're basing our dollars, our value off of the dollar bill itself, something that's totally different from that gold that they were using. So if you were to think about what the next level or next step of the money evolution is going to look like, well, think about how kids are able to buy things online at this current point. They're using virtual money. So if your child ever asks you about Fortnite or asks you about these V-Bucks, well, they're taking actual dollars and buying virtual things with them with virtual currency. So just imagine that people are trading this virtual currency between individuals and they have a certain value. And if you were able to take that value out of the game itself, that's basically what your cryptocurrency can provide for you, like your Bitcoin or Ethereum. There's a lot more that goes into it, so please make sure after this, we do our own research on this. But these are some ideas of what your assets can look like if you're looking to place money somewhere to watch the dollars grow. And then we cannot forget about the things that we cannot see, the things we cannot touch, the intangible assets. So your education, your skills, your network, that relationships you build, any intellectual properties, all of these are things that you can't physically touch, but can provide you a lot more value than you can expect. And I really want to be clear on this when it comes to your education and building up your skills and that being a valuable asset. Because remember, assets are things that pay you. Assets can be things that have value that can continue to put money in your pocket. And if you were to take $1,000 and let's say you put it into the stock market, if some by miracles or some just great year, you were able to return like 20% on that for the year, right? Just to take an example. Well, you take 20% of 1,000, that's $200. Yeah, you made $200 for that whole year. You break that up by 12, you don't have a lot of money to use for whatever you need to use for. However, if you were to find a skill or some type of program you want to be a part of, and let's say it costs $1,000, but this will put you in a position to where your skills will grow to where if you have a certain job or a side hustle that's paying your bills, you upskill in that, get better at what you're producing, better at your marketing, better at what you're doing for your business. That probably can return you $200 quicker than you waiting for the whole year, waiting for your investments to do so. So having investments are important, but investing in yourself is key to generate actual capital to make it to where you really want to go in life. Any questions on this?
I have a question.
Absolutely. Go ahead.
Go back. So, am I able to put my education on my balance sheet as an asset?
Well, you may not be able to do so verbatim like that, but think about what it can do for you. Because if depending on how you do it, so let me take example from what I do. So when I go and take another course or another class, I can take what the amount of money I spent for that class or for that course and deduct it from my taxes because there is a certain tax credit you receive for
Ah,
education for those upskilling. So not only are you putting money towards something that can put more money in your pocket, you have a way to reduce the amount of money you owe at the end of the year for your taxes, for business taxes. So you may not be able to, some accountants might not allow you to put it on there as a tangible asset. However, understanding that you do have some value that you can get from this on the front end and the back end is why you want to think through education as that asset there. No, it wasn't necessarily a question you asked, but hopefully that answered why you
okay.
would treat it that way.
Thank you. Yep.
No problem. Absolutely, absolutely. Any other questions? All righty. So since we're talking about assets, I know I painted a very pretty picture that assets are just the bee's knees, as the cool kids would say. However, you do want to think through some things that are considered good assets and versus some that are considered bad assets. So when you think of good and bad assets, think of, well, let me take a step back because you may see this out there lectured like this to you, but I want to let you know that when it comes to the real terms that people use, like appreciating or depreciating, there's not necessarily a bad thing to it. It's a negative connotation to it. But when you think of a depreciating asset, depending on what type of depreciating asset you have, I know I'm skipping ahead a bit here, you can take it and make value out of it, but I am jumping a gun or jumping ahead too far. I want to take a step back and talk about what is considered the good assets. So when you think of good assets, these are assets that provide capital for you, put money in your pocket just by owning them. So your index funds, you invest in the stock market, hey, those are your assets working for you because as the value of the companies you invest in grow, so does the money that you invest. So on average, when you adjust for inflation, you're looking at about a 7% return on average for the stock market. And this is an average, right? It doesn't happen every year. Do not expect it to happen every year. However, if on average, as long as you stay invested into the market, you should receive a 7% return on those assets, making it appreciating. There's more value growing to it. Real estate. Real estate is an interesting one because your appreciating asset, like real estate, you can take a look at the market now. You see that stock or the prices of homes are rising, right? So if you were to sell that home, you may be able to sell it at a higher price, more than what you bought it for, giving you a return on your investment. And you also have a way to make money off of rents, off of leasing, all different things. So it makes your appreciating aspect or asset in that aspect, but this is where the idea of a depreciating asset being bad isn't the right context to think of it in. Because when you're depreciating asset like real estate, okay, okay, okay.